Good morning. This is Michael DeVille. We are in beautiful Phoenix, Arizona. It's June 30th, 2020. Tatum and I are in the studio today, and we've got a very, very important webinar today. You may have questions, and of course, this is a live webinar. Tatum is here to monitor. So if you look on your screen, you'll see in the upper right-hand corner a place that you can put questions in. If you type any questions in, Tatum will go ahead and try and flag me, and we'll try and answer your questions live if we possibly can. We're also going to make the presentation available. You're again welcome to the PDF. You're welcome to the slide presentation. You are welcome to the YouTube. That should be placed up late this afternoon. Now, last week we were really privileged. I just had a wonderful week. I was able to talk to both Walter Zimmerman and Charles Nenner within about a week or 10 days of each other. I'm going to tout those videos today. You should, if you get a chance, take a look at them. They're about 20 to 30 minutes long, just chock full of information, and so terribly, terribly timely for our marketplace today. And this gives you an idea to talk to your financial planners, talk to your clients, to find out what's really, really good for you. And the information from these gentlemen, they're both analysts, world-class financial analysts. The track record of both of them is just unbelievable. So take a look at them. We're going to discuss a little bit. We want to recap some of the things today, but please go and take a look at them. And I want to recap as to when you talk to a financial advisor of their caliber, you really need to just kind of mull on what they're saying, think it through, and if it's appropriate to take actions. But you probably want to take this up to your financial planner, and let's discuss the research. So last week, two brilliant world-class analysts came to the same conclusion. Now, both of them use separate analysis. They use separate methodology, but they're coming to the same conclusion. So when that happens and you have that type of a synergy, then you really need to really start thinking that maybe it's time for us to take action. So Walter Zimmerman, who's on the left of your screen, is kind of he would be an institutional analyst. He would talk to Morgan Stanley. He would talk to big companies and making decisions. He's one of the finest analysts in the world. He's made some unbelievable calls. And Charles Nenner, of course, is probably a little better known than Walter because he's just in a different class. Both of them, Walter uses Elliott wave analysis, and Charles Nenner uses cycle analysis. They both come to the same conclusion. We're going to talk about that conclusion as we come through. Now, Walter Zimmerman is talking about a gap island reversal top. Now, keep in mind, this is a technical term, and he's one of the top technical analysts in the world. When you look when you see him on the video, he's going to talk about that this gap island reversal top you can often see in penny stocks. You can also often see in some of the small NASDAQ or bio stocks that really have no depth to them. They're not well traded. He says, but when you start to see it on the S&P, he's never in his life seen a gap island reversal top in the S&P ever. And he thinks it's one of the most ominous signs in an ominous market he can ever see. So he's saying that the downside risk is growing in the stock market, and that you should really talk to your financial advisor to find out what is truly good for you. Now, Charles Nenner uses a completely different approach. He also, both of them, independent of each other, using their own research. These guys are very, very sacred when it comes to their research. They don't talk to anybody else. Their research is their pride and joy. They don't talk to anyone, but they both came to the same analysis that the stock market bounce is over. Now, if it's over, you need to talk to your financial advisor and find out what is prudent for you. Because as you get older, we can't get this capital back. And I'm going to tell you that a lot of the baby boomers I talk to are extremely heavily invested in the stock market. And they have 60, 70, some of them have 100% of their nest egg in the stock market. And if the bounce is over and we're looking for a leg down, this could be ominous for anyone who's heavily invested with all of their assets in one class. Now, I'm going to tell you that you have to understand that the stock market makes the economy just look like it's fabulous. And we have bounced off the bottom. We had everyone out of work. So when half of the people went back to work, that means you had a 50% increase in employment. That's an historic rise. But when you go from 0 to 50%, that means you're still in dire straits. And although the stock market is looking great and there's been a lot of liquidity put into it, the economy itself is in shambles, and it may have bottomed on the recession. Maybe we're going to know in the next 30, 60, 90 days, but we're a long ways from recovered. In which case, keep in mind that in 2009, when we bottomed on the recession, it was a jobless recession. So keep in mind there is still some jeopardy in the marketplace. You need to talk to your financial advisor on that. Now, we've had injected into the economy in the last 12 weeks $7 trillion worth of liquidity. I don't think they're finished yet. The Federal Reserve and the Treasury are just putting tons and tons and tons of money into the economy. They've done this through just direct mail. Everyone's gotten $1,200 from the government. They've had increases in the unemployment, and liquidity is just coming. They're buying bonds, they're buying stocks, they're putting liquidity into the market. And of course, in the most liquid markets is where this liquidity shows up, and that's in the stock and bond market. And it is very, very possibly creating tons and tons of bubbles because you're getting this liquidity that's going in. We have just a crazy, crazy marketplace. Hertz was in the news. Hertz is in bankruptcy, and Hertz was going to issue $500 million of absolutely worthless stock, and people were going to buy this. The SEC had to step in and prevent them from buying this stock or selling this stock. And that just tells you what craziness is in the market. This stock was worthless. Hertz is in bankruptcy, and people are going to buy a stock from a bankrupt company. This is insanity. And this is because there's a tremendous amount of liquidity that's going into the marketplace. And talking about liquidity going into the marketplace, we have a 5-year Treasury auction that went off last week at historic low. For 5 years, if you'd have bought a Treasury, you'd have gotten 0.33% return for 5 years. Now, why would you lend any money to anybody for less than 1/3% of interest? That's 0.33%. You would have to have mountains of cash to just pay your electric bill. This is the insanity that's going on now. That could be, if you're concerned as a cash substitute, that would certainly be a good one. But it's certainly no route for any kind of cash flow for yourself. You certainly can't live on a 0.33%, and the 10-year is less than 0.7%, less than 0.75% for 10 years. There is something dramatically wrong with that. And what's happening is that the Federal Reserve and U.S. Treasury are dumping money into these markets, and quite honestly, they're blowing probably one of the biggest bond bubbles ever. And of course, that goes over into all kinds of municipalities. You've got goodness gracious. I mean, I wouldn't want any Illinois bonds, municipal bonds, or California bonds. I read this morning that CalPERS is going to borrow money for their pension fund. They're going to borrow more money when we have rising interest rates because we are down to the bottom. It doesn't look like we're going to go negative, but we are really at the bottom unless we go negative, and that would be a disaster, quite honestly. I don't think that's happening. And if you look at this point and figures chart that Charles Nenner has given me, you're going to see that the support line was broken. And once that support line gets broken, and of course we're almost at zero. Where can it go but go up? And of course, rising rates are just a death knell for a bond portfolio. And if you watch the video, you're going to see Walter Zimmerman say that this is the most ominous market in 40 years. And if you just look at some of the parallels, this is not unusual to get a huge bounce after a market. That's happened in 1929. It happened in 2000. I remember that because I was around for 1929. I know I look old, but I'm not quite that old. But in 1990 and in 2002, we had a huge dot-com bubble. It bounced back up. I think it came up almost 40%, and then the NASDAQ crashed down 78%. So this is not an unusual formation. And Walter Zimmerman's calling it the most ominous market in 40 years. So you need to talk to your financial professional and find out what your exposure is and make sure that you are comfortable with where you are in the marketplace. Now, this is just talking about some of the data that we've had, and I want to tell you that this is the 1929 crash with the current 500. You can see how it is just tracking the same course as the 1929. It seems that we grow old, but we never learn. We all repeat the same mistakes. It's just an amazing fact. So this market and the 1929 market are following the same path. That is a great big concern for you. If you're in the marketplace, you need to talk to your financial advisor, because once that bubble crashes, it's going to be gone, and it is gone, and it is gone. And if you're my age, we cannot get that money back. And literally, when I sit down, keep in mind, I consult with people every week, and a lot of the people my age have all of their money in the stock market. What if it dropped 20 or 30 or 40%? They're not going to feel so wealthy anymore. And I'm going to tell you, if you watch the videos, Walter Zimmerman says one of the greatest places that you can be in the stock market right now is on the sidelines. And it is very, very difficult to sit on the sidelines and watch the market go up and up and up. But if you are my age, you do not need to be invested 100% of the time. You don't have to have all your money in all the time. Maybe it's a good time if you want to have some stock market exposure. Talk to your financial professional. But if you want some stock market exposure, put the rest in cash. Make sure that you're safe. This is time for capital preservation. And in talking to both Charles and Walter, cash is a separate asset class. Keep in mind, stocks are a separate asset class. Bonds are a separate asset class. Commodities are a separate asset class. Gold is a separate asset class. And real estate is a separate asset class. So keep in mind, you can take that cash and just put it on the sidelines. It doesn't have to stay there forever. We certainly want to keep that cash working for you, but talk to your financial professional. If there's risk in the marketplace, which you can certainly see, the economy really is struggling to recover. We're having lots of problems in the economy. There are absolutely no earnings in the S&P. Keep that in mind. The companies are not making any money. So let's just recap where we are. If you're a day trader, you might think that this would be a good place. If you're a long-term trader, you need to really talk to your professional, put some stops in, figure out where is it that I'm going to exit the marketplace. How much do I want to keep safe? Take a look at your portfolio. If you're in a mutual fund, find out what's in the mutual fund. What's currently in there? And are you comfortable with what they're holding? Because stocks may be very, very overvalued. There are no earnings. And the technicals, which you can see from the two top technical analysts in the world, are saying there's huge risk in the marketplace. And I don't think anyone can argue the fact that there's virtually no fundamentals. Every company in the world is struggling to make sure that they can pay their bills. So this is not a huge economic success at the moment. So technicals are bad and fundamentals are bad. So you have to ask yourself, what am I doing in the stock market? And of course, the same thing goes with the bonds. There is huge risk. There's both, if we indeed have bottom on the interest rate curve, and interest rates lose money when rates go up, when they call it a bottom, that means they're not going down anymore. And the next move is up. That makes it very, very difficult for a bond portfolio. but we've got the added ingredient of risk. We have default risk everywhere, just absolutely everywhere. Look at Hertz, look at J.C. Penney, look at Ford Motor, look at GE. These were just stalwart companies that are in big trouble today. Talk to your financial professional. If you have a bond mutual fund, find out what those bonds are in that fund and make sure that you're comfortable with it. Now, the economy and the stock market, again, we've talked about the fact that they don't coincide. Cash is a very, very good place to be. Cash will keep your money. Now, cash can be cash. It can be in the banks. It can be anywhere that's guaranteed, your savings accounts. It can also be in short-term treasuries. There we go. I'm sorry about that. And both of the analysts talked about yield. And of course, a lot of our clients are baby boomers. My clients are baby boomers. This yield that we get off our investments, we live on this yield. So it's extremely important that it stays safe and conservative. We want to make sure that we can count on that money. So the cash flow, where do you go for cash flow and yield? One of the only places in the world that you can go to is single family residential rentals, not going into commercial, not going into retail, not going into industrial real estate. We're talking about very, very conservative. Now, real estate is generally a very conservative asset to begin with, and we're looking at an extremely conservative asset within that asset class, single family homes. Typically, we're looking at things that are in the entry level or just above the entry level, and we're going to rent those out to long-term tenants. And this is going to give you a cash flow that you can live on. It's going to be 10 times what you can get in the treasury market. You're going to be able to get something that you can go ahead and spend, and this should be a very, very safe place. Now, not every property is a good rental. Every property will probably rent, but it's not every property should be a rental. You should not necessarily buy. So talk to your professional, talk to someone, and find out. Probably in your marketplace, you should be able to find something that you like. Certainly here in Maricopa County, we're just loaded with them, but there's several good markets or places around the country. You can certainly get those and a good cash flow for you. And I'm going to tell you, in both videos, the analyst suggested that one of the great places that you can stay for years would be into single family homes and cash flow for yourself. Which brings me up to those that are already in the market. I know a lot of my clients have cash. They have cashed out their homes. They are free and clear. If indeed we have bottom on the interest rate curve, which both analysts seem to think that we are there, I'm not expecting these rates to just skyrocket. I'm not expecting them to go up very much, but I don't expect them to go down either. So at this juncture, this might be the place that you want to look at your portfolio, talk to your mortgage professional, and see if you have any liquidity needs yourself. If you need any cash, this would be a very, very good time for you to take cash out of some of your properties. Not only that, but I think we're going to have an opportunity to start buying properties. You may want to deploy that cash in other properties. So this would be a very, very good time for you to start thinking of taking some money in your properties. Now, I'm going to say if you're going to do that, you probably are looking for a 30-year fixed rate mortgage, and those are dirt cheap. And in 4 or 5 years from now, you may be patting yourself on the back saying, wow, I sure was bright taking those mortgages out when I had that chance. So take a look. You're welcome to call me. You're welcome to brainstorm with me. You want to talk, make sure that you never jeopardize your asset. Want to make sure that you get plenty of cash flow for yourself and that you're not trading dollars, because we certainly want to get you a little bit of exposure on the leverage, but we want to maintain that cash flow for you. So you're welcome to call. You're welcome to email. We do this on a day-by-day basis. We're more than happy to do the calculations for you. Now, you're welcome to call me. These are very tumultuous times. We have private consultations every week. If you'd like to email me, we can maybe get you in next week or the week afterwards. We got the 4th of July coming up, and we're more than happy to take a look at your portfolio. We're more than happy to talk to your, do a conference call with your financial advisor, with your accountant, and see what's prudent for you, if any of these will fit into you. We're welcome to do your rental analysis if you want to talk about maybe putting some leverage on your property and find out what's good, how much leverage you possibly can have, and what's going to be good for you. Keep in mind that my book sales. I've had several people call me. Book sales are really anywhere books are sold, anywhere in the world you can get my book. So you can get a book online. A lot of people go to Amazon. You're welcome to go to my website. We can sell it to you there. And we did a 1031 exchange video 2 or 3 weeks ago. I've had an enormous amount of calls from that. If have already sold a property and you've already relinquished that, and you're looking for replacement property, you're welcome to call us here. We'll be more than happy to find a replacement for you. If you want to explore that, we're more than happy to talk with you about that. It's not very, very difficult. Most people will know how to do that after you've done it 2 or 3 times. You're going to be an expert at it too. It's very, very simple. But if you want to find out if it's good for you, keep in mind we'll do the rental analysis and the calculations for you, and we'll just review if that's a good move for you or not. And you're welcome to email me as well. So I want to thank you very, very much. We're being very, very cognizant of your time. I want to thank you very, very much for listening today. Tatum will have this up on YouTube very, very shortly. And if you have any kind of questions, you're welcome to privately ask me. My very best to you. Make it a good week. Bye-bye now.